Imagine waking up one morning, logging into your loan account, and realizing you could be paying hundreds less every month without some shady trick or risky gamble. Sounds too good to be true. That's exactly why you should stick around, because by the end of this video, you'll know how student loan refinancing actually works, how it could save you thousands over the life of your loan, and when it could backfire. Number 1. What student loan refinancing really means. Think of refinancing like trading in your old loan for a brand new one. Same debt, different deal. You take your existing student loans, whether federal or private, and replace them with a single new loan from a private lender. The goal? Usually a lower interest rate, smaller monthly payments, or both. For example, if you owe $40,000 at an interest rate of 7%, refinancing to a 4% rate could save you more than $6,000 over 10 years. Number 2. How it works step by step. First, you shop around for a lender. They'll check your credit score, income, and debt-to-income ratio. Then they make you an offer, interest rate, repayment term, and monthly payment. If you accept, you're new. Lender pays off your old loans in full, and you start making payments to the new lender instead. Picture it like moving to a better apartment. Your rent might be lower, but you've signed a new lease with different rules. Number 3. The big benefit. Saving money on interest. Interest is the silent money eater. Even a 1% lower rate can make a huge difference over time. Let's say you have $30,000 at 6% for 10 years. Your monthly payment would be around $333, and you'd pay about $10,000 in interest. If you refinance to 4%, you'd pay about $304 per month and save nearly $3,500 in interest. Number 4. When refinancing makes sense. It's usually a smart move if you have high-interest private loans, a stable income, and a good credit score. Think 670 or higher. Also, if you can switch from a variable rate to a fixed rate during a low-interest period, you can protect yourself from future rate hikes. Example, if rates are climbing, locking in a fixed 4% could save you from paying 7% 2 years from now. Number 5. The hidden downside you can't ignore. If you refinance federal student loans with a private lender, you lose federal protections, like income-driven repayment plans, deferment, forbearance, and potential loan forgiveness. So if you work in public service and could qualify for forgiveness. After 10 years, refinancing could cost you tens of thousands in lost benefits. That's why experts say, never refinance federal loans unless you're 100% sure you won't need those protections. Number 6. Credit score and approval factors. Lenders look at your credit history, income, employment stability, and debt-to-income ratio. Example, if you earn $60,000 a year, have a credit score of 720, and your total monthly debt payments are under 20% of your income, you're likely to get a better rate. If your credit isn't great yet, consider refinancing later. Once you've improved your score, you'll get much better offers. Number 7. Term length trade-offs. Shorter terms mean higher monthly payments, but less total interest. Longer terms lower your monthly payments, but increase total interest paid. Example, a 10-year loan at 4% might cost $304 a month, while a 20-year loan might drop to $181, but you'd pay almost double in interest. It's like paying for a pizza now or over 20 years. Sure, smaller bites are easier, but it costs way more in the end. Number 8. Fixed versus variable rates. A fixed rate stays the same for the life of the loan, giving you predictable payments. A variable rate starts lower but can go up over time based on the market. If rates are expected to rise, fixed is safer. If they're expected to drop or stay low for years, variable could save you money. Example, in a rising rate environment, a variable rate starting at 3% could climb to 6% in a few years, wiping out your savings. Number 9. Costs and fees to watch out for. Some lenders charge origination fees or prepayment penalties. Always read the fine print. Example, if the savings from refinancing are $2,000 but the lender charges a $1,000 fee, your real benefit is only half of what you expected. Number 10. How to choose the right lender. Look beyond just the interest rate. Consider customer service, repayment flexibility, and any extra perks like unemployment protection. Example, some lenders let you pause payments for a few months if you lose your job. Others offer a cosigner release after a set period of on-time payments. Number 11. Timing your refinance for maximum savings. Rates can move up or down depending on the economy. If you see rates dropping, it might be the perfect time to refinance. Example: if you wait until rates fall from 5% to 3%, you could save thousands over the life of the loan. But if you wait too long and rates rise again, you miss the window. Number 12. Refinancing more than once. You can refinance multiple times if it makes financial sense. Example: if you refinance from 6% to 4% and 2 years later you can drop to 2.5%, you can refinance again to save even more. Just make sure the fees don't eat up your savings. Number 13. Common refinancing myths. Myth: you can only refinance once. Not true. Myth: you must have perfect credit. Not true. Good credit helps, but some lenders cater to borrowers with fair credit if they have strong income. Myth: it always saves money. Not true. If you choose a longer term, you might pay more overall even if the monthly payment is smaller. Number 14. What happens after you refinance? Your old loan balance will show as paid on your credit report, and your new loan will appear as a new account. Make sure your old lender confirms the payoff to avoid double payments. Keep making payments on your old loan until you get official confirmation. It's like not handing over your house keys until you know the buyer's check is cleared. Number 15. A quick checklist before you decide. Ask yourself, do I have a stable job and income? Is my credit score strong enough for a lower rate? Will I lose any federal benefits I might need? Am I okay with the new term length? Have I compared multiple lenders, not just one? Number 16. Impact on your credit score. Refinancing can cause a small, temporary dip in your credit score because of the hard credit inquiry. Over time, if you make on-time payments, it can actually improve your score by showing responsible debt management. Example: if your score drops by 5 points after refinancing, it could bounce back and even increase within 6 months of consistent payments. Number 17. Using a cosigner to qualify. If your credit score or income isn't strong enough, adding a cosigner with good credit can help you secure better terms. Just remember, the cosigner is equally responsible for the loan, so missed payments can hurt both your credit scores. Example: a parent with a credit score of 780 might help you get a 3% interest rate instead of 5%. Number 18. Consolidation versus refinancing. Federal loan consolidation combines multiple federal loans into one but doesn't usually lower your interest rate. It just averages them. Refinancing replaces your loans with a new one, potentially lowering your rate. Example: if you consolidate a 6% loan and a 4% loan, you might end up at 5%. Refinancing could drop it even lower if you qualify. Number 19. How income affects your offer. Lenders want to see that your income comfortably covers your expenses. The higher your income compared to your debts, the more likely you'll get lower rates. Example: if you earn $80,000 and have only $500 in monthly debt payments, your debt-to-income ratio is excellent, making you more attractive to lenders. Number 20. Tax considerations. Interest on student loans may be tax deductible, up to a certain limit. If you refinance and lower your interest, your deduction amount could shrink. Example: if you currently deduct $1,500 in interest per year, refinancing to a lower rate might reduce that to $900, slightly affecting your tax refund. Number 21. Employer student loan repayment benefits. Some companies help pay off employees' student loans. If you refinance with a new lender, check if your employer's benefit still applies. It may not. Example: if your company pays $200 per month toward your loan, losing that benefit could outweigh the savings from a lower interest rate. Number 22. Emergency repayment options. Some private lenders offer temporary payment pauses for hardship, but these aren't as flexible as federal forbearance. Before refinancing, see if your potential lender offers any safety nets. Example: one lender might give you a 3-month pause for job loss, while another gives 6 months. Number 23. Automatic payment discounts. Many lenders offer a small interest rate reduction, like 0.25%, if you set up autopay. This can add up over the life of the loan. Example: on a $50,000 loan, that small discount could save you over $300 in interest. Number 24. Refinancing multiple types of debt together. Some lenders allow you to refinance student loans along with other debts, like personal loans. This can simplify payments but could also blend high and low-interest debts into one. Example: combining a 7% personal loan with a 3% student loan could raise your overall cost. Number 25. Prequalification without a hard credit check. Many lenders let you check rates with only a soft credit pull, so your score won't be affected. This lets you compare offers safely before committing. Example: you could get pre-qualified offers from 5 lenders in one afternoon without impacting your credit score. So, refinancing your student loans can be a powerful tool, but only if you play it smart. It can save you thousands in interest, lower your payments, and simplify your life. But it can also cost you valuable protections if you jump in without thinking it through. If you had the choice today, would you refinance your loans for a lower monthly payment or keep your federal benefits for safety?